I think by the end of the year, we are going to be, let's say, firmly over 2100, meaning 2100 will then be a floor, not a ceiling. Whether it's 2150 or 22, I don't know. I tend to be a little more cautious on prices than a lot of my friends. So let's just stick with 2100. I think gold is, first of all, I think it's definitely going to be up, and it's going to start taking off when the Fed cuts rates. If we see the first rate cut in March, typically the Fed doesn't do one rate cut and then stop. We're going to see a progression of rate cuts throughout the year.
Gold firmed on Tuesday after a pullback in the US dollar and Treasury yields. At the same time, traders positioned for remarks from several Federal Reserve officials this week to gauge the likely pace of interest rate cuts this year. AdrianDay, the chairman and CEO of AdrianDay Asset Management, foresees a series of rate cuts post a potential March cut, expecting gold to surpass $2,100. Adrian points to central bank purchases as the primary force behind the gold surge since October 2022, driven by worries about the US dollar's weaponization. According to a Wednesday report from the World Gold Council, the banks bought 229 metric tons of the precious metal in the fourth quarter of 2023, down from 382 tons in the year-ago quarter. Over the full year, purchases declined by about 4%, to 1,037 metric tons in 2023 from 1,082 in 2022. Meanwhile, he attributes the recent gold surge since October to a perceived shift in the monetary framework, with the market reacting positively to central banks' transition to lowering interest rates. The bullion's appeal as a safe haven asset has risen since Israel's war with Hamas began on October 7th, contributing to gold prices notching an all-time high of $2,100 an ounce last month. Regarding the recent decline in gold, Adrian attributes it to a shift in expectations of rapid rate hikes, reflected in the Fed funds futures. Gold price delivers a steep downside move, as investors see a rate cut by the Fed delayed to May. The outlook for the precious metal has dampened as it has failed to sustain the breakout of the symmetrical triangle chart pattern formed daily. However, Adrian notes that global gold ETF outflows and flat coin sales suggest regular investors aren't driving the gold price surge. Now, we present the clips of AdrianDay's insights from his recent interview with Resource Talks. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Right. Well, first of all, since October 2022, the main factor driving gold, as you and probably everyone knows, has been central bank buying. Central bank buying has been at record levels pretty much every quarter. We don't have the last quarter's numbers yet, but up until the third quarter, it's been at record levels. And that's really what's been driving the price of gold. There's no question about that. And central banks have been buying, I think, largely because of the U.S. weaponization of the dollar and the financial system, whether it's the what do they call it, the SWIFT system and everything else, and the confiscation of Russian assets. The confiscation, not through a court process, but just plain confiscation. That has caused a lot of central banks, as we know, to say, do I really want so much of my assets in the US or subject to US confiscation? And so the best asset that is out of the system, if you like, is gold. So it's clearly been central bank buying that's been driving gold. If you look at other indicators of physical gold buying, you look at the ETFs, well, we've had net outflows from ETFs since October of 22. Even in the last month, which is astonishing, we've had net outflows from global gold ETFs. So it's not what we'll call regular investors that are buying. You look at retail, good indication of that is coin sales. Coin sales are flat, premiums are way down, particularly in the United States. And so it's not been retail. So it's all been the central banks. In the last 4 months, really, since the beginning of October, we started to see gold move up. And I think the primary reason that gold has moved up since October, beginning of October, has been a growing sense of a shift in the monetary framework. So gold, as you know, when a central bank moves from hiking rates to lowering rates, gold always takes off at that point. It has for the last 6 times we've had that shift. And I think largely the move from October was the market sensing that we're close to that shift. We've had a couple of spikes since then on the Israeli and then broader the Mideast situation. But those have tended to be very short-lived as geopolitical moves in gold are typically short-lived. So it's been primarily the monetary situation. And what we've seen, I'm just looking at my graph here, excuse me, looking over, but since about January, well, since the middle of January, we've seen gold retreat. And that's been as the sentiment towards short-term or near-term and rapid rate hikes has retreated. So middle of January or early January, the Fed funds futures that I mentioned was 88% saying the Fed would cut in March. It's now a little bit under 50% saying the Fed will cut in March. So logically, you would expect gold to retreat on that.
AdrianDay expects a slow return of institutions to gold, acknowledging it will take time. Central banks collectively bought more than 1,000 tons of gold for each of the past 2 years, a pace unprecedented in modern history. According to the World Gold Council, total gold demand hit a record last year and is expected to expand again in 2024 as the U.S. Federal Reserve moves toward cutting interest rates, potentially aiding prices. However, Adrian identifies central bank buying for safety, stock market dynamics, and the underperformance of gold companies as the main influences on gold prices. Despite the current prices of gold, many investment banks continue to maintain a bullish gold price outlook. However, the central banks continue to bolster their gold reserves, highlighting the enduring appeal of the precious metal. Furthermore, he predicts a gold upswing as the Fed cuts rates, especially with stock market instability. A slight increase, from 0.5% to 1%, could impact gold prices. Let's get back to the interview.
They're going to pile in and jump in, but they're not going to pile in immediately. It's going to be, because people have been out of gold for so long, particularly institutions have been out of gold for so long, and generalist investors, it's going to take a little bit of a while before they come in. So I wouldn't use the word pile in. They might pile in next year or the year after. But, you know, history says that when the Fed starts to cut rates, gold starts to move up. And we've seen that, as I say, in the last 5 or 6 rate cutting cycles. The institutions in the US are significantly underweight gold to where they normally are or traditionally have been. You know, the average gold holding among all investors is less than 0.5% right now. The last 20 or 30 years, it's been as high as 4%. So it's going to take us time to get back to 4%. But I think when the Fed starts cutting rates, especially if the stock market starts to, let's use the word wobble. I'm not talking about a collapse, but wobble, and people start looking for other assets, then I think we'll start to see gold move back up. And it won't take an awful lot of that buying. You know, if we go from 0.5% to 1%, that's going to have a very meaningful impact on the price of gold. Yeah, I think there's 3 main reasons for that. One reason is, as we said, you've got to look at what is the reason why gold went up over the last 18 months. It's the central banks. Central banks are looking for safety, insurance, you know, on the long term. And so therefore they're buying physical gold. The central bank's not going to buy, you know, consolidated Ajax. So that's number one. I would argue, and I had this discussion, you know, with people 6 months ago and 9 months ago, I would argue, although I'm a bull on gold, I would argue that it was the gold price that was out of kilter with the economic reality, not the gold stocks. The gold stocks were perhaps fairly valued. The gold itself was overvalued. That's changed now, I think. So the second factor is the stock market. You know, when the broad stock market, and particularly the technology stocks, are doing really well. People don't look at things like gold stocks, things like oil stocks. And the stock market starts to, and the longer that carries on, then the less people start looking at other asset classes. So that's the second reason. And frankly, the third reason is, gold companies, the gold stock sector has not served investors, broad investors, generalist investors. It has not served them well over the last 15 years.
Many experts anticipate a rise in gold prices this year, so buying gold now could lead to higher returns. In contrast, after hitting an all-time high in 2023, the price of gold is expected to remain high as geopolitical uncertainty and declining interest rates provide support for gold, and it is predicted to average more than $1,900 per ounce, just as it did in 2023. What are your thoughts on these factors influencing gold's outlook, and how do you perceive the evolving dynamics in the gold market? Share your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.